Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and we're excited to have you join us today. As we navigate the complex landscape of investing, it's essential to stay up to date on the latest trends and opportunities. One area that's gaining attention is dividend stocks, which can provide a relatively stable source of income for investors. In a recent article, 3 excellent dividend stocks were highlighted as potential additions to your portfolio: Realty Income, BlackRock, and Ares Capital Corporation. Realty Income, a real estate investment trust, stands out for its predictable cash flows and long history of raising its dividend. With over 15,000 commercial properties under long-term leases, the company has established itself as a reliable player in the industry. Its monthly dividend payments, rather than quarterly, make it an attractive option for investors seeking regular income. BlackRock, on the other hand, offers a unique blend of income and growth. As the world's largest asset manager, the company has benefited from growing trends in passive investing, with its iShares brand providing exposure to a range of themes across industries and sectors. With a dividend yield of around 1.8% and a strong track record of raising its payout, BlackRock is an excellent choice for investors seeking a balance between income and growth. For those willing to take on a bit more risk, Ares Capital Corporation offers a high dividend yield of over 9%. As a business development corporation, the company is required to distribute 90% of its taxable income to shareholders, making it an attractive option for investors seeking higher income. However, it's essential to note that lending to middle-market companies carries risk, and investors should carefully consider their investment decisions. It's crucial to remember that every investment comes with its own set of risks and rewards. As we explore the world of dividend stocks, it's essential to approach each opportunity with a critical eye, considering factors such as company performance, industry trends, and overall market conditions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of corporate finance and credit markets in our middle segment today. A recent report from Bloomberg has highlighted the growing trend of private credit firms deploying record amounts of capital, with the Alternative Credit Council noting that these firms have reached a new milestone in their investments. This surge in private credit deployment comes as companies like Netflix and Paramount Skydance are seeking massive financing deals to back their ambitious projects. For instance, Netflix's planned acquisition of Warner Bros. Is being financed through a $59 billion check written by a trio of Wall Street banks. This deal showcases the increasing reliance on debt financing in the corporate world. However, not all companies are finding it easy to navigate the credit markets. Oracle Corp's credit risk has reached a 16-year high due to concerns over its huge artificial intelligence investments and the potential impact on its profitability. Meanwhile, distressed disposals, where restructurings are being fast-tracked by cutting out minority lender groups, are becoming more common. It's also worth noting that regulators like the European Central Bank are taking steps to change the market for AT1 bonds, aiming to make them more akin to equity capital. This move could have significant implications for the credit markets and investors. As we explore these developments, it's essential to consider both the opportunities and risks associated with the growing private credit market. While it can provide much-needed financing for companies, it also increases the potential for debt-related issues and market volatility. In conclusion, the world of corporate finance and credit markets is complex and multifaceted. As investors and stakeholders, it's crucial to stay informed about these trends and their potential impact on the economy. Welcome back to the Riskwiser Zone. As we close out today's show, let's take a look at some of the latest developments in the world of finance. We've been following the story of the U.S. Federal Reserve's interest rate cuts and how they're impacting markets around the world. One expert who's been sounding the alarm on the potential risks of these cuts is Andrew Freris, He's been warning that the Fed's decision to cut rates without having all the data is insane, and that it could lead to further instability in the market. Freris has also been critical of the focus on AI-driven stocks, saying that they're overvalued and due for a correction. He's not alone in this assessment, as many experts are starting to question the long-term viability of these investments. With earnings disappointments and heavy capital expenditure with little visibility on future returns, it's clear that there are some major red flags waving. But what does this mean for investors? Freris is advising caution, particularly when it comes to U.S. equities. He's suggesting that alternative opportunities in defense, European markets, and parts of Asia may be more attractive. And, in a surprising twist, he's also flagging India as a potential safe haven, not because of its exposure to AI, but because of its lack thereof. As we consider these developments, it's clear that the world of finance is full of complexities and uncertainties. As investors, it's our job to stay informed, to do our research, and to make smart decisions based on the data. So what can you take away from today's show? Be cautious of the hype surrounding AI-driven stocks. Keep a close eye on interest rates and their impact on markets, and don't be afraid to explore alternative investment opportunities. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.